Namaskar guys, this is Stock Yatra and we are looking at the series of lectures on the basics of the Indian stock market. We have completed 8 video lectures. We have discussed the primary market and IPO market yesterday. Now we will be discussing the indices and derivatives market. We will have a small introduction into the indices and derivative market. This will not be a elaborate course. This will be a brief class. So what are indices and derivatives? Indices are indicators of the market performance. Just like we have GDP, that is an indicator for the entire nation's earning capacity. We have Nifty and Sensex, which are indicators for the entire market's performance. So we have market-wide indices and sector-specific indices. Market-wide indices, we have two of them. One is Nifty. Nifty stands for NSE's top 50 companies. So NSE's top 50 companies is Nifty. It is an indicator of the NSE, National Stock Exchange Market, and Sensex stands for Sensitivity Index. It corresponds to the BSE's total market performance. It is based on the top 30 companies on BSE. The selection of these top 50 and top 30 companies is beyond the scope of discussion here. We'll be looking at them in the futures and options course, which will be coming soon. So stay tuned and hit the bell icon to get notifications on futures and options course. Now, just like we saw Nifty and Sensex is for the entire market, we have sector specific indices. We have Bank Nifty, which corresponds to 12 banking sector stocks. Then we have the Fin Nifty, that corresponds to the financial services sector. Likewise, we have Nifty IIT, Nifty Auto, etc. These are sector specific indices. They provide a outlook on the performance of that particular sector. Nifty is currently at the range of 19,000. It had touched 20,000 a few weeks ago. Initially, in 2001, the standard was set at 1000 points Nifty, which means that today's market is performing 19 times more than what it was performing in 2001. This is the meaning of Nifty, and Nifty is valuated in points and not rupees. Likewise, even Sensex and other indices are in points and not in rupees. The uses of index. There are multiple uses of indices. Okay. These indices are not just indicators, they also form an asset class on their own. They are called derivatives. To give you an idea of derivatives, let us take the example of a locker. Now, inside the locker, let us say you keep 5 lakh rupees hard cash and you lock the locker. Now, the key of the locker is just a 10-gram piece of metal which is worth just 5 rupees. But this is the intrinsic value of the key, but its derived value is 5 lakh rupees because it is safeguarding 5 lakh rupee worth of product inside the locker. That is how the key derives the value from the underlying. Here the underlying is the amount of cash lying in the locker and the derivative is the key. For example, if you had placed 25 lakh worth gold in the locker, the value of the key would be 25 lakh and not 5 lakhs or 5 rupees. This is how derivatives derive their value from the underlying. Likewise, even indices have their own derivatives which can be traded just like any other stock. Other uses are, it provides an information or general market performance. So if Nifty is at 19,250 today and Nifty goes up to 20,000 in the next week, it means that the market is performing well and most of the stocks are going to be bullish between this period. That is how you derive information on the general trend of the market. You can benchmark the performance of a particular company against the index. So if Bank Nifty is bullish, it is rising, but a particular bank, let us say ICICI Bank, is falling, it means that ICICI is not following the general trend of the other banking sector stocks and there is something wrong with ICICI. This is how you benchmark it against the index and you analyze stocks and investments. You can trade in the derivatives of indices. These derivatives are called futures and options. You can hedge stocks. You can hedge derivatives with indices. Hedging means it is a feature to minimize losses just like stop loss. But here hedging means that even if the market goes up or market goes down, you are making a limited amount of profit no matter what is the general direction of the market. So you are limiting the profit as well as limiting the losses. This is hedging. We'll look at hedging in a separate video. I will attach it in the description soon after I upload them. We saw what are derivatives, what are futures and options. So the difference between futures and options is that futures both are contracts or agreements for trade. So you are going to trade the underlying. So if it's a Nifty option, you are going to trade Nifty. If it's a FinNifty option, you are going to trade FinNifty. If it is a stock option, for example, it is a Tata Motor stock option, then you are going to trade Tata Motor. So these are contracts to trade the underlying. But the difference between futures and options is that futures are obligatory or mandatory contracts. You do not have the right to determine if you want to perform the trade as per the contract. You don't have this right. But in options, you have the right to choose to apply the contract or execute the contract. That is the basic difference between futures and options. We look at them in a detailed and simplified manner in futures and options videos. That's it with the indices and derivatives. And we have just one more module, that is the economics, which deals with the numbers and charges in the stock market. So stay tuned for this video, which will be uploaded soon. Thank you. Jai Hind.